Good afternoon, everybody, and welcome to this TradeStation educational event. I'm Don Prattle from TradeStation, and with me today is John Seguin of Market Taker Mentoring. His topic is profiting from time-tested chart patterns. John's going to discuss some of the most consistently profitable chart patterns that he's observed in his 30 years of trading in the futures markets. Remember that everything we talk about here is for educational purposes only. All the symbols, all the trading ideas, and everything we discuss are for demonstration purposes. They are not recommendations. This presentation is not an offer or a solicitation of any kind in any jurisdiction where a TradeStation affiliate is not authorized to do business. Remember that active trading is not suitable for everybody. Options trading also carries a high degree of risk and may not be suitable for all traders. This may not be have much to do with the topic we're describing today, but I've included in the chat panel the two very important pieces of disclosure information. First of all, the characteristics and risks of standardized options, and another document outlining the other products that we have access to here at TradeStation. Now, in the next month or so, you might want to think about, especially if you're from the upper Midwest in this current climate, you might be thinking about coming to Plantation, Florida for an outstanding event that we have planned here at TradeStation. The TradeStation Future Stars event is designed to help you jumpstart your futures trading. Linda Bradford Rashke, Rocky Horner, David Stendhal, Anthony Credelli, Creek Bewick, Michael Burke, and Larry Williams are the stars of our show at the Future Stars trading event on March 8th, 2019. Make your reservations for this event right now. It's a one-day event on Friday, March 8th. Learn more at tradestation.com/promo/futures-stars. Also in March, if you have always wanted to become a master trader, and that is if you wanted to master the TradeStation trading platform, join us for the TradeStation Masterclass in Plantation at our headquarters here in Florida for March 25th through March 29th. Register now. Click on that banner at the top where it says Learn More. In the TradeStation Masterclass, you'll take a deep dive on the TradeStation trading platform for 2 full days, a day of strategy development and testing, 2 days of easy language fast track programming at the TradeStation headquarters in Florida. Along with all of the education, we've got some outstanding guest speakers that will be joining us across those 5 days and some very cool social events. So think about spending a week with TradeStation in Plantation, Florida from March 25th to March 29th. Now, John's going to discuss how to determine profit from fair value in any time frame, offering simple tips to improve the timing of your trade entries and your exits, how to recognize the onset of momentum early in a trend, how to analyze price action quickly, and identify and react to developing patterns, and also how to define risk and profit potential. So let's turn things over to John Seguin right now of Market Taker Mentoring. For our presentation today, I'm very happy to have these guys with us. John Seguin and Dan Passarelli and John Kamisic are old friends of mine. They've done some excellent work in the education space, and they're great education partners of TradeStation. So please pay close attention, and I'm sure that you're going to enjoy this presentation. John's going to share his screen right now, and I'm going to step out of the way. So you have a great event.
Thanks, Don. Okay, I just want to make sure everybody's seeing this screen. Should be looking good. Don's already done the disclaimer. Thanks a lot for coming today. Very quickly, we don't have a lot of time, so I talk fast. And I'm going to talk a little bit about, first of all, I'll let you know that I worked at the Chicago Board of Trade and Mercantile Exchange for over 20 years. I've been on my own teaching, trading, and developing some software, developing trading systems. Been doing that for quite a while now. And wow, I'm going to share some of the stuff that I found out over the years with you. First of all, as a broker down on the exchange, I developed this trader checklist here, and after dealing with institutional traders, mainly I spent most of my time in the 30-year bond pit at the Chicago Board of Trade, sometime in the grain room, sometime in the S&P, but generally I was dealing with institutional traders and executing orders and trading pits, signaling into those pits. But one of the things that I had to be prepared in this highly competitive business. I had to be very prepared for any questions that these guys might ask me and the information that I could give them from the trading floor. The trading floor, there was such a luxury being on a trading floor because you could see who was buying, how much they were buying or selling. The order flows that you could see could help you really learn to read price action or decipher the auction process at its very basic, or the most fundamental, um, the fundamentals of a market. But as I was dealing with these people, there were questions that they would ask on any given day, but they all centered around these 7 elements here, or components. They want to know who's controlling momentum, who's been buying or who's been selling, and how much. What's fair value? I mean, momentum is actually the movement away from fair value. So it was important to know where most of the trading was occurring, what price was being traded more than any other. Once I'm in a trade, how do I know when I'm wrong? That's what I believe risk is. If I'm bullish and momentum turns negative, well, that's how would I define risk. Is the timing right to actually being a trade for let's say a vertical move, or a trend up, a trend down? Or is it better off to be maybe an option trader, maybe selling premium? Is the timing right for that kind of a contrarian trade? Where's good support levels and resistance levels? Where do I get in or exit? Where do I get out? And once I'm in those trades, how do I manage that? How do I hold on to it, lock in profits as the market's going in my favor? These are the things that I was asked by all the clients. And so I developed a system that really was able to show in charts what we used to see on the trading floor. And it was, how do you read momentum to recognize when a trend is kicked in or about to kick in? And so the things that you really need to focus on, first of all, who moves markets? It's the entrance of institutional traders, supply and demand. If there's more buyers than sellers, the market's going up. If there's more sellers than buyers, the market's going down. Simple, right? But how do you recognize when they're coming in? We're not on trade. There's no trading floors. That information is not available anymore. You have to look on screens and charts to get that kind of information. Well, the markets give us clues. And I'm going to break it down for you a little bit just to show you how to read very, very short-term price action, because by understanding short-term price action, you'll be able to enhance your timing of entry and exit. The better you enter a trade, the less risk you have, your risk decreases, and your profit potential increases because of timing, recognizing when the onset of a trend. So that's something we're going to talk about today. Really, I don't have time to go through all kinds of stuff, and but we can. I can show you some examples and some pictures that'll make you feel a little bit more comfortable about recognizing when opportunities arise. And of course, the first thing we want to do is, hey, we want to know, when are these institutional traders likely to be trading? They're the market. They're the ones that are moving the markets directionally. When do they play? Well, that's why we track mainly the most liquid time of day. That is regular trading hours. The first hour of regular trading hours is the most liquid time of day. The highest volume period of the day is the first hour of that trading day, and the second is the last hour of the day. And that's when you see a lot of the institutions trading. Because liquidity is high, they're able to get large orders filled without moving the market against their positions. Now, I'm going to show you a little, back in 1985, 86, in that area, I was down on the trading floor, and just about everybody down there was doing some sort of charting, either looking at books. We didn't have computers that gave us the charts at our desk there. It was just too compacted, and well, computers at that time were, you know, big as Volkswagens. So, uh, you know, there was computer banks that we could get charts and generate charts from and have to bring them back to the desk and whatever. But, you know, so you have bar charts and point, point and figure charts and candlesticks and all the indicators there. But while I was doing this, and everybody was doing pretty much the same thing, basically bar charts. But I came across a method of charting called market profile. And I want to break it down to you and show you a little bit about what market profile is, because it's also when I really got into this and went to one of the market profile or market logic school, I realized that this was the most efficient way to read price action and understand what was actually going on in trading pits and bring that to a screen. So let me just give you the basics of it. If you were to take this is a candlestick chart, and if you were to take this chart and assign, this is a 30-minute bar chart, if you were to assign each 30-minute period of the day a letter, this is what it would look like, all right? So the first period of the day, when the market opens up, A period, B period, C period, so on, we close an M period, so, and then we go ahead and do it right again the next day. Now, if I were to take that method and just assign a letter, instead of a bar, replace it with a letter, this is what it would look like. So I got a high of 29, a low of 16 in the first half hour of the day, and so forth and so on. You got 21 as a high, and it looks like a bar chart with letters. But the trick with market profile, or what they call, it's a bell curve, we're tracking time at price. It gives us another dimension. By tracking time at price, you can see here that at this price here, every 8 of the 13 half-hour periods or 12 half-hour periods that traded during the day, we visited this price. And the idea is the more time you spend at price, the more volume accumulates, hence you have a fair price. And what's momentum? Momentum is the move away from a fair price. So getting back down to basics, if we can establish what a fair price is, we can start to go through that trader checklist, because, hey, riding a trend is actually catching momentum. So this bell curve here is the structure we're going to be talking about today, because it gives us another dimension. The vertical dimension that everybody watches in their charts, or average true ranges, or the difference between the high and low, and or the open, high, low, close. Those were the dimensions we got to use to create strategies. But when you add this time dimension, it really helps increase or enhance the timing of entry and exit a trade. Now, there are a lot of things that come within looking at a market profile or a bell curve. And I just want to tell you how it works when a market opens up. So let's say this is our opening price right here at 28. And immediately when that market's open up, if I was on the trading floor and I see this market shoot straight down, and you see how there's no time spent here, only one print here at A, this is a sign that sellers are super aggressive. That because in a trading pit, when the market opened up here, if you were looking at a trading pit, you would see everybody's hands up in the air. And if you were looking at that pit, you would see their knuckles. They're jumping up and down trying to sell. When brokers or traders are trying to sell, their palms are facing inside a trading pit. So that was a nice thing we got to see in the trading floor. You look up and see, geez, just about every broker is out there is trying to sell. That's a very powerful sign that the institutional traders are looking to short or sell the market. So that was one indication. And by using market profile here, this very low volume single prints is an indication that sellers are in control of momentum, okay? So normally when markets open up that first hour, they take about an hour to find balance. That's what I'm talking about here, initial balance. That first hour of trading is critical. Markets will gyrate back and forth, and find a balance in that initial hour. Often when a market is, by the way, just a cue here, When markets are trending higher, they tend to make their lows in the very first hour of the day. When they're trending lower, they tend to make lows or highs in the very first hour of the day. So there's a really nice little indicator. If you're looking for a short-term signal, I would definitely pay attention to that time of day. It's critical. It can be critical. So in this first hour that day, we have a high of 29, we have a low of 09, and then you see that we bottom out at B, and then the market starts going through these gyrations. And as time passes, you can see that a high volume price is forming. So I've got one indication that sellers are in control of the market because the high was made in the first hour. And then the next read on whether these institutions are coming in is when that balance, that initial balance, is upset. That means that the institutions now, not only were they selling early today, but they're figuring the market's going, they're going to push the market even lower still. This profile here says that markets are, or that sellers are in command of momentum by making a high in the first hour and the extension after that first hour. These are just short-term signals, folks, okay? But this is kind of a neat way to break it down to say if you're in a trading pit, you would see, geez, we've been sitting between 22 and 09 for about 3 hours, and all of a sudden it just violates that and breaks through, and now you've got a whole new read on momentum. And then the last thing I really like to do, another thing, okay, let me just say this. There's a thing called a value area. And really it simply is, if this is my mean or my high volume price, if I know what the fair price is, I can construct a value area. And I'm not going to go into all the crazy stuff, but it's essentially a standard deviation of volume around the mean. It's a bell curve. And it's instrumental for a number of things. And we can talk about that some other time, but it's great for defining risk. If I think a market's supposed to go down or likely to go down because sellers are in charge, if it violates my upper band of value, that's my risk. I was wrong. Value areas can really help you define risk. And we're not going to talk about that much today, but generally that's what they're for. There is a lot to gain from organizing the price action this way. I've got a value area. I've got a high volume price. A value area helps me define risk. A high volume price tells me who's controlling momentum. A close below that tells me that sellers are still in control. So in this example, I know that sellers were operating early in the day as the market extended lower, and it closed below the fair prices, which tells me it's likely to keep going lower in search of buyers. That's what markets do. They keep going higher to search for sellers. They keep going lower to search for buyers. We have to recognize when the change has occurred. When a trend is ending, there are little signals that occur as well. And in some other presentations, I could show you how to read that a little bit more and recognize when change is coming, when trend is coming. But we're not here to talk about that. We're here to kind of give you a basic idea of how to read short-term price actions and recognize when a trend might occur. Now, I don't use market profile anymore. I used it for years when I was on the trading floor. And I realized that it's not a tool that's available to everybody. But what I have done is I've taken 30-minute bar charts and applied my own sort of spin on them. And I can tell you this, just as if a price trade, so here's what, 1, 2, 3, 4, 5 different times, right? And here, 1, 2, 3, 4, 5 different visits to this price. Generally, in a 30-minute bar chart during regular trading hours, if a price is visited 5 times, it's considered part of value. That's just a general rule. Here's my high volume price. That's where 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 different visits to that high volume price. You don't necessarily have to have a bell curve to recognize the data that are important. So I've got my first hour high, extension down, close below the fair price. All that says to me is that this market is likely to continue lower to search for buyers. And this is how you kind of ride trends. As long as you've got momentum that continues to come in your favor, you can use these value areas to define risk. And every day the value area goes lower, you can move your risk down and risk down and risk down and lock in profits as you go. So the really short-term momentum indicators that we're going to talk about here, or I'm going to show you, uh, is what's important. The first hour extreme. Was a high or low made in the first hour? Was there an extension either up or down after that first hour or initial balance? How did the market close in relation to the fair price? And you think about it. When there was during let's say a rally, there was oftentimes you would see a market open up maybe sharply higher and then trade down all day long. And then right at the end of the day, it swooshes up. Buyers come in and it closes right above the fair prices. This is a very common kind of thing in an uptrend. So how the market closes in relation to the fair price could give you an idea of who's in control of momentum, right? So in order to identify when a market's ready to trend, there's a couple things we need to know, all right? As a trader, you want to think of yourself as sort of a detective. There is a ton of information in just reading charts. You just have to learn how to interpret them. And we'll go over a few examples here. So first of all, we need a market that establishes balance or a fair price, right? The other thing I think it's super important is understanding the range. What's normal with ranges? It's called an average true range. I think every charting package out there has that as an indicator. You want to know how much does a market typically move on a given day, a week, a month, a quarter for that matter. How wide is a typical value area? And of course, we want to gauge speed. How do I know when a market's gone too far, too fast? So if a market's trending, when do I know it's about to come to an end? Well, there's indicators out there that show us when a market's gone too far, too fast, otherwise known as overbought or oversold. That's what OB and OS means. Those stochastics and RSIs and moving average, convergence, divergence, better known as MACDs, those are good indicators for it. But what are they really telling you? Do you know? And so we're going to talk a little bit about that. And then, of course, the average true ranges is what I just said. You just really need to know that if you're going to be a trader, you're going to want to know what the professionals are using to make decisions. It's a very logical process. I think of it more of like market logic. As a matter of fact, that's what this Pete Stottlemyre, who invented market profile and brought it to the exchange, his first book was called Markets and Market Logic. I highly recommend it as a read. I think it's, you can probably find, I'm sure you can Google it and find it, but Markets and Market Logic, Pete Stottlemyre, it really kind of changed my life after reading a bunch of technical books and all these other, and being on the floor and competing with all these other guys that were doing their types of charts. I was one of the first ones around my area that got into market profile, and it absolutely changed my life because it brought logic into reading charts. So let me break it down. When I'm looking for a breakout, I have a short-term trading system that I use every single day. And this is just one I'm going to share with you. Now, what we're looking at here is silver. And you can see that I've got 30-minute bars here, but they're going 24 hours a day pretty much, right? But I mean, I care what's going on during Asian hours and European hours. That's these hours over here. But the highest volume times of the day are during regular trading hours in the U.S. I am going to focus on those hours because they're the most liquid. That's when the big players are playing. I really want to concentrate my analysis not so much on extremes, but on value. If I understand value, what else do I know? Well, when a market moves away from value, that's a sign of momentum. So this little brace that you see here, this is the length of an average day range, right? Average true range. So if I see 3 days in a row, 72-hour period, concentrating on regular trading hours, if I see 3 days in a row of severe overlapping value areas with below average ranges, it's a sign that the market's ready to bust out. All right, this is just a neat little thing you might want to look at. I realize a lot of you don't have the ability to make these, but to make these charts. But severe overlapping prices that are below average in range over a 72-hour period can be a great short-term indicator. So if you have, think of it, if you have a long-term, you say, boy, it looks like this thing's ready to break out long-term. Wait for the short-term stuff to kick in, and it'll tell you, it might tell you the timing is right now. Now let me show you something here. When markets are trending down, highs tend to be made in the first hour, extensions are down, and closes are below high volume prices. So let's look at it. On this one right here, the market topped out early, made an extension down, but closed above the high volume price. Okay, not a good signal. When markets are about to turn, they do something a little different. Right before trends, you start to see things that are called like neutral profiles or neutral days. Look at this one. Here's my first hour. It extended both above and below that. And it closed at the high volume prices. What does that tell me? This market has shifted to neutral. Markets often shift into neutral right before they take off. Well, I've got a neutral day here. I've got not a very good signal here. I've got below average ranges. This market looks like it's ready to go somewhere. Which way is it going to go? Well, there's one thing that you can do. You say, listen, if it gets above there or it gets below here, the next day, I'm going with it. That's it. I'm looking for a breakout. I don't care if it goes up or down. Just that it's going to go. Now, let me get rid of this for a second. Okay. So this little signal, just by watching these values, that tells me if it gets above that, I'm going long. Below that, I'm going short. Now, could I have, and the next day, the market opens up. Remember now, when a market is above value, what's it doing? It's looking for sellers. And the first thing you get when the market opens up above value here is what? Buyers are in control of the market. That is a sign of power. So as a trader, you constantly got to ask, where is this market in relation to the previous value area? And if it's above it, it's asking for sellers. I should be seeing a high made in the first hour here. Instead, I'm getting the other sign. Remember I told you if people are selling in the trading pit, if you were looking at it, you would see their knuckles and they're jumping up and down. Their palms are facing in trying to sell it. If they're trying to buy it, it's the opposite. If I'm looking at them, I'm seeing their palms. They're jumping up and down and I'm seeing palms. This is what it would look like. If this market opened up above value and then all of a sudden everybody in the trading pit, I'm looking at their palms. They're trying to buy. And that's when you get these crazy, big, huge moves that are far above the normal range. This is how trends typically start. But there is this period of neutrality often that occurs. Not every time. Nothing happens all the time in trading. But when we're talking about patterns and recognizing when potential is there, you have to recognize when a market is wound too tight. Now, there's Bollinger Bands out there. I'm sure some of you are aware of those. When moving averages converge too tight over a long period of time, that's a sign of neutrality. There are a number of ways to do it. I'm just showing you a visual of what those indicators might give you. I think visualization helps you understand exactly what you're doing. Someone might tell you, hey, use this indicator, this one worked, but you don't know why, but you trust that guy, or said, hey, give it a try. But knowing the whys, what is this thing really trying to tell me, is more important than anything. That you understand the logic behind it. That understanding consolidation and what happens before a market is ready to break free is important. Here, I'm looking at the Mexican peso. Look at this. So here's my average day range. And by the way, the colors, I use colors to help me with reading momentum. So Mondays are always purple, Tuesdays yellow, Wednesdays blue, Thursdays are red, and Fridays are green. It's just something I do. And you'll see why in a little bit. So I'm looking at Mexican peso here going, boy, 4 days in a row, same prices. And then all of a sudden, this market opens up below value, and you get these things that I like to call sprints. When markets establish fair value, you get what are called sprints. And sprints are simply a bunch of single prints. See that little low volume thing there? Right there? These single prints, if you put single and prints together, you get sprints, and that's exactly what the market's doing. It's sprinting from value. But if I didn't know what value was, it would be hard to recognize that, right? So that's key. First, recognizing when a market is wound too tight. Now, as the market keeps going down, the highs tend to be made early in the day, and then we get near the low here. Look what happened. We got a neutral day. It makes a new high after the first hour and a new low. Does it here too, and then that was the end of the trend. So the market almost told us it had like 2 neutral days in a row just before it reversed and went the other way. Okay? Here I'm looking at the Canadian dollar. I actually did this trade this week and did very well with it. I've had 3 days in a row, bought it when it busted out here. I actually kind of like to work stop orders, like a buy stop to get long or a sell stop to get short, just in case the move occurs while I'm sleeping. But the idea was that, hey, we've got 3 days in a row below average volume or below average ranges and above average time at price. And that's when the market sprinted away. There's your sprint. These low volume, you see these low volume runs from high volume prices. Get that? Low volume runs from high volume prices. I would recommend, and this is something I share with all my students in my classes, is that you keep stats of the markets you prefer to trade. Know how much they move on what's an average day range, an average week range, month range, quarterly range, because this is the way we can tell when a market's gone too far too fast. I'll give you a good example. I know that if I've been writing a trade and I see that it's moved the length of an average week in a 48-hour period. Now, my RSIs and stochastics might tell me that it's getting overbought, but to me, that's what it's trying to tell me. If I see a market move the length of an average week in a 48-hour period, it's going too far too fast, I'm taking something off the table. Because it's likely to go into a holding pattern, I'm probably not going to make a whole lot of money on it over the next, say, 36, or next 2 days, 3 days. While the market relieves that overbought issue. Markets do 2 things, right? They trend, they consolidate, then they trend again, then they consolidate, they trend again. They move from balance to imbalance. We have to recognize when one type of trade is likely to occur. My style, the trading program that I prefer to run is a breakout one. I'm looking for periods of consolidation, recognizing when a market's ready to go vertical. There are contrarians that love to play the other way. They look for markets that are overbought and oversold. Then you go into this mean reversion style trade where you're in, out, speculating over 3, 4, 5 days. I think, as a trader when I was on the trading floor, that was a nice style because you were right there in the trading pick. You could get out in split seconds. Speculating was great. But now that the trading floor really doesn't have much to offer, and all this trading is done on screens, I prefer the other way. To jump on the back of the institutions because they're pushing the market directionally, recognize when did they come in and get right on there with them. So I use these average true ranges, and I highly recommend that you do that for all your, for the markets you like to trade. Just be aware how much your market's likely to move. It may tell you that, hey, when the market's going too far too fast, time to ring up your trade. Okay? Now, here we're looking at the Dow Jones, and this was actually earlier this month. This was a great trade for the mini Dow. And I want you to look at this over 4 days here. Almost identical value areas for 4 days in a row. And then I'm sitting there going, I don't know which way this thing is going to go. But if it gets above here, I think there's a good chance the market will continue higher. And if it gets below there, there's a good chance all I'm saying is that it's likely to break out. But look what happened the day before it broke out. Made a low in the first hour. It extended up. It closed at the high volume prices. That tells me the buyers have a slight edge. I don't really know if there's a breakout yet. But then the next day we make a low in the first hour, extended up, close above the high volume prices. Now the market's supposed to go higher to attract sellers. It'll keep going higher, higher, And as the market's going higher, I'm using these value areas to define my risk. As long as the market stays above these value areas, I'm locking in profit. And it keeps going higher until what? You get those either neutral days or you'll start to see highs made in the first hour and extensions down. This is the sign of change. This is why breaking down really short-term price action can tell you when a trend is near an end or ready to keep going. Now, the thing that I did when I was on the trading floor, I used to do a lot of this charting by hand. And as I was doing it, and I used to run this squawk box for our companies, and it was really, it was just a bit like being a color commentator at a sporting event. Hey, it's 2 bid at 3. There's 300 on the bid. There's 400 offered. The 4s are trading. There's only 100 left. Now it's 4 bid at 5. There's only a little bit left at 5. Now it's 5 bid at 6. There's no 6s offered. Now it's 7 bid. You know, just kind of telling. It was on a squawk box that was piped into New York, Chicago, London, and even Japan. Just kind of giving an idea of what was going on the trading floor. And over time, I noticed that really when markets went through these lulls or really, just really low volume periods, that they developed these really normal distributions where you see how symmetrical these bell curves are? So what I'm doing here is I'm actually tracking time at price. I'm not looking at first hours. I'm not looking at, that's not what I'm here for. What I'm tracking is the time at price. I'm concerned here about width. Because the more width there is, the more likely a trend is about to begin. It's the same thing. Those value areas, same thing. This is just a different look. What you saw here is what's going on here. But now I get to measure time at price. So whenever I see a market that's got way too much time at price, so you know how I was talking about the ATRs, the average true ranges for length? I watch average true, how much time is spent at price. Did you know that the high volume price every day, you're likely to see it just on an average day, you're going to see that price about 8 or 9 different half-hour periods. But if you see it 10 or 11, there's a pretty good chance the market's going to be moving. That means it's wound too tight. The opposite of overbought and oversold. This is the opposite of overbought and oversold. When you're looking to catch trends, you got to find markets that are wound too tight. So how do you recognize that? Well, that was the whole idea that I had long ago. I said, hey, if these same principles that apply in the short-term trades, that if I can read short-term price action, that if momentum is truly the movement away from a fair price, why wouldn't that logic apply if I just extended my time frame? So what you're seeing here is a dollar index, and each one of these is a day, okay? And what I have here is a thing called time at price. So each day, on an average day, the high volume price is visited 9 times. And I also know that the range on those days is about 0.5, about 50 ticks, right? Now, I also know that by a week, that the average time at price is about 18 visits. I'm going to see that price trade 18 different times. That's just average. Then an average week's range is about a point in 110 ticks, 1.1. And I'm sitting here going, boy, I get this. This chart that you're seeing on the left is exactly the same chart as that I'm seeing on the right. It's just now, instead of taking these days or those 30-minute periods and stacking them on top of each other, why don't we just take the days and do the same thing? So now, when I'm talking about breakouts, I'm not talking about a move that's going to be, wow, if this thing's wound up by the day, when it moves, it should expand at least a day's range, maybe 150% of a day's range as it breaks away. Now I'm looking at something longer term going, hey, if I look at it by week, this thing is wound up by the week, like right here, that when that pent-up energy is released, now I'm shooting in my trend trade, I'm looking for not just a day range. Now I'm trying to capture a full week's range. When there's think of it as pent-up energy. If a market sits still for 3 days and it releases, the chances of it moving more than an average day range is very high. Well, the same thing applies if you look at it by week or month or quarter. That when you find a market that's wound too tight, and it doesn't matter what time frame, that you can start to assume or project how far that energy, when it's released, is likely to carry the market. It's just like overbought. When a market travels, when it moves like for 4 weeks in a row straight up or straight down, there's a pretty good chance it's going to go to 2-3 weeks of sideways trade, relieving that overbought or oversold condition. Again, we're trying to break this down so simply into, is this market ripe to run or ready to rest? Is it going to trend or consolidate? Well, when the odds favor a big vertical move, when a market's wrapped too tight. Now, so look at this. On an average week, right? Average week, my visit to the high volume price is 18 times. And this one, it visited 29 times. And the range is typically 1.1 or 110 ticks. When I see ranges like I showed you earlier, when the ranges are below average and the time at price is above average, this is when you want to impart your breakout trades, that trends are likely. Now, if you're an option trader and you really don't, you could just buy straddles and strangles in this instance. Because the odds are favoring a vertical move, you can make money whether it breaks out up or down. You're not sensitive to direction. Or you wait for the direction to show itself. Think of it this way. When I see something like this, I'm going to look at my short-term charts and go, hey, was the high made in the first hour? Did it extend down? Did it close below the fair prices? Not only is this thing ready to go, but sellers are showing that they're in charge. And that's how it happens. You take this, you get some perspective from a longer-term view, and you let those short-term clues that I was showing you earlier tell you if the timing is right to get on that trade. You have to be able to look more outside of just one day at a time, or you need to have some perspective. I prefer 30-minute bar charts that are broken down into days. You see how I organize those into days, and weeks and months. Just so you know how to read or understand when a market is ripe and ready. So to become a market detective, really, you just got to be able to read the clues. The clues are in the charts, folks. You just got to kind of break down what you're looking for in those charts. Not everything is just a trend line. It's really, to me, it really became a way of life when I started looking at realizing that there is incredible amounts of information inside the charts. That what I learned on a trading floor can be read in a chart if you know what you're looking for. And you understand that it's where is the big money, where are the flows? Can I read those? So understanding the read time at price, your vertical ranges, the market's going too far too fast, well, your chances for a good vertical trade, if it's already played out, they're not good. This is all about probabilities. Nothing is cut in stone when it comes to trading. Nothing. But it is about probabilities and understanding when a market is ripe to go vertical or horizontal. Of course, the horizontal dimension tells us get ready for sprints. Sprints are trends. My goal, sprints to me are like lightning in a bottle. When the right setup is there, I know that that the odds are favoring a sprint. And a sprint is a moneymaker. That is what sprints occur in every trend. Every trend I've ever seen. At some point, you get this rush from value, this thrust away from fair. And of course, the other thing is once you're in a sprint, recognizing when that direction is ready to change. Now, so here what I'm doing is I'm showing you a 10-year note chart. This is actually up until Friday, I believe. And I just want to point out a couple things here. These are weekly macrographs. Macrograph is the charting software that I developed. And I did it so that I could take data, organize it into structures that I prefer. whether it be a 3-day structure, a 1-day structure, a week, a month, a quarter, whatever. It needed to be versatile so that I could organize data to tell when a market is wound too tight. Wound too tight. Look at this. Look at all this time at price right before this thing took off. Look at all this time at price. 2 weeks in a row. Almost the exact same high volume price. Boom, shot up. Another one happens again. Boom, shot up. This is all in the last couple months. 10-year note was on a great trend, and now take a look at this, folks. Which this almost happened by mistake. But I found, you know what, when I write newsletters every morning and send stuff out for commodities traders, right? And I go, hey, I noticed that every time a market comes back to a high volume price, it tends to be very good support or resistance. I mean, look at this. We're making lows every week at high volume prices. Now look what happened here. Look at this. This right here is a market that's wound too tight. What's this one? Range is way too big. This is way overbought. Has no horizontal dimension. This market's ready to go into a holding pattern. This is too far, too fast. This is too fat or too wide, right? Too far, too fast, and too wide. Just think about that when you're setting up your trades. Look for markets that are doing something that's not normal. Is it overbought or oversold, or is it wound too tight? Here, I'm going to be playing for trend. Here, I'm going to be selling volatility and try and make money on time decay and options, or even just counter trade the market. So recognizing these things, and the reason why, what I wanted to share with you today is that you don't have, these are visuals. These are to tell you, to show you, well, what the numbers would look like, okay? And I'll get to that before I get out of here. I'm probably taking a little bit too long, but anyway. So here's crude oil, or not crude oil, I'm sorry. This is USO. By the way, I use this stuff with stocks. With stocks, the ETFs, I use it for all of it. This is the ETF USO, which tracks crude oil. And what we just saw in the 10-year note, look what we're seeing in crude oil. Now, more than anything, I want to just show you this. Well, here is a market definitely that is wound too tight. And again here, but look at this. I just look at this. If I were to say, hey, the week closed below the fair price, that means sellers have momentum. Hey, it closed below the fair price again, and again, and again, and again, and again, and again. And this market still hadn't closed above a fair price. Why the heck am I getting out of a short position? And the thing, these value areas, you see this? That's the top of my value area. This is what I use to define risk. Let's say I sold crude oil here. There's my risk. Then the next week, I'm moving my risk down to here. Now it's here. Now it's here. Now it's here. Not once have I had been taken out of this trade, because when a market's moving lower, I'm going to use this value area for what? To define my risk, to trail my stop, to keep me in the trade. So you can see when the market gets wound a little too tight, good vertical move. Wound a little too tight, another vertical move. However you use it in the software and whatever your charting package has to offer, find a way to understand too tight or too far. Here is crude oil, one of my favorite. This is crude oil. So this is a continuation of this chart. This is what USO looked like. Here is the week of 10-1, right? We'll look at crude oil. Oh, I'm sorry. Go back there. Here's the week of 10-28 or 10-29 right there. This one. We're going to pick up the crude oil chart. You can see, there it is right here. Right there. You can see this trend kept going and going and going. What happened? And it went into a holding pattern. Sideways for a little while, relieve the oversold condition, do it again. And then all of a sudden, look what happens. Now you're closing above high volume prices for the week and the trend turns the other way. Just by understanding a fair price, I can tell what momentum is. It's very logical, right? If a market keeps staying below the fair price, that means sellers are in control. If all of a sudden the markets finish out and are closing above fair prices, well, that means bulls are in control. Here's crude oil. Now I'm going to step out, and now we're looking at a month. Patterns repeat in all time frames in all markets. You just have to recognize when a pattern presents itself that gives you an opportunity for probability, whether it's a trend trade or a counter trend trade. Look at what happened with gold here. Look at this tiny little range and above average time at price before it went off. It might have taken a little while to do it, but that was a good indication that a market has run out of steam. Markets were made to facilitate trade. Facilitating trade means when it's moving in a direction and volume is still good or average, it's likely to continue on in that direction. When you see a market moving down like you did here in September when gold bottomed out, the ranges get smaller. The time at price gets larger. That's a sign of change. So gold, I mean, this is like a $10,000 trade here in a 3-month period. But again, it's the same thing. As it's going down, as long as we're below the value areas, okay. Now that the market's turned over, now it's got to stay above the value area. I use bottoms of value to define risk in a rally, and I use the tops of value to define risk in a decline. And incidentally, markets tend to, when they get going, they'll tend to keep going until they run into another high volume price. So when I see a trend developing, I'm going, how far is it going to go? Well, what's an average month range? I should get that out of it. Where's the next resistance level? Boy, I'm just not seeing any resistance until this gets up here. And as a matter of fact, I think gold is right around here right now. So it looks like it's coming up to this area. And so I would be looking at this going, okay, maybe it's a little overbought and now it's coming into resistance. Maybe I'll take a little profit because old high volume prices tend to be very good resistance or support when you revisit them. Let's talk about perspective here and look at it by quarter. This is the Russell, the IWM ETF. It's IWM, the Russell ETF. These are quarters. So now we're talking about, look at this quarter here. This was the election back when 2016. But you can see on the rally up, this market was pretty consistently staying above fair prices. And then look what it did here before it turned back in July. Really, really small range, below average range, above average time and price before we had that nasty spill in October. So if you're going to be a trader, a future trader, an equity trader, ETFs, doesn't matter. If you want to approach it and do the right thing, you want to think like a pro. They have research departments. You have logic. You have the answers. You can get the answers. But know what they're searching for. They need to know what value is. They want to know who's controlling momentum. Where is my risk? When does momentum change? Is the timing ripe? These are the questions they seek to answer. Where do I get in? Where do I get out? And once I'm in, how far is this market likely to go? And how do I protect my profits when I'm in there? These are the things that I teach in a class every day. I came up with an acronym that I use. Think about Vertex. Every time you approach a trade, think, I've got to cover these components just to hang with the pros. And you will become a better trader because you are covering the elements that are needed. It's logic. I'm not telling you anything this is all market logic. And the charts allow us to read short-term stuff, to maybe get some long-term answers. So here's why I'm here, I guess. I have this classroom that I teach every day at 10:30 in the morning. I do record it, and I do give trades. We actually do live trades. There are lessons every day. It's about searching 32 different markets, just the futures markets. Then we look at some ETFs, and we'll look at the Dow 30 stocks on occasion. But what we do is we search for patterns that are giving us opportunity. And in all that, and we cover all the sectors. So, and they're all sort of intertwined, right? What happens in interest rates, I believe, is really what kind of controls markets. That is the dog that wags the tail, because interest rates will certainly affect foreign exchange and maybe the equity markets and possibly precious metals. It may have an impact on grains even because of the interest rates, or livestock. But these are the things that we cover day in and day out in a classroom environment. So here's what I guess I'm here to tell you is, if you'd like to join that classroom, you can. And I just told you, we'll just go over the techniques, and I teach every day on how to read your charts, how to set up your charts. I'm more than happy to ask questions. I want you to be a good trader because I'm going to be doing a lot of the trades that we talk about. So if you're interested in becoming a better trader, but you got to do some work. I mean, this is not like there is no holy grail thing, but it can be fun. My kids growing up, they played video games. What I do, making those charts, that's my video game. I just absolutely love the search for looking for patterns for day, weeks, months, and quarters. And so I have charting software on my website that you guys would be able to use too if you so care to. Okay, this is not if you're here to get rich, if you're indecisive. This is not a Band-Aid. This is a way of building up a strategy and becoming your own market timer. And if you're really serious about being a trader, you have to remember who you're playing against. All right. You're going to play with the pros. You better train like them. So if you're interested in coming to a class, you go to this thing right here, markettaker.com/JS99. So here's the deal, all right? Normally this costs 227. It costs, I don't know, I forget what they charge, all right? But it's like 200. If you sign up for this thing today at markettaker.com, you get for 227 bucks a month after the first month. That's what it would cost. You get these futures impact videos, which are really nice. If you're new to futures trading, can certainly help. I also run this, I'm part of this chat room that you're involved in that the trades will be posted in. So here's what you get today. 1 month of futures. You get to come to futures trading, 10:30 every morning. That's Central Time. It's recorded if you can't make it because there's lessons in every single one. You get the video impact, you get the chat room, and then I will show you how to read market profile, how to read the charts, how to make the charts. You get all that stuff. We'll give it to you for 99 bucks today. You go to markettaker.com, JS99, and check it out for a month. Now, so markettaker.com, blah, blah, blah. Now, before I go, I guess I got to show you this. And if that doesn't interest you, this is my website. It's called macrograph.com. You can go on here and register it. I cannot, I'm not going to give away free trials on it yet. I can't do that. That's something I'm discussing with that could happen down the road, but we're just not quite prepared for that yet. But if you're interested in making these kind of charts, it's really kind of cool. And like I said, here's my video game. So for example, I'll go, okay, let me see. Let's look at Apple. Let's just do that. So we're going to look at Apple, and we want to look at it by, let's say, by month. Now let's just look at it by week, and I can hone in on the time frames I want to look at if so be. I want to see the value areas on that, and if I want to show a summary profile, which is kind of a neat thing. Okay, so let's say I want to see what's going on. What are we? 5 weeks? Yeah, I'll just go 9 weeks, and we're going to hit a create chart. So I want to get a picture of Apple by day or by week, and boom, there it comes. So now I've got weekly profiles, right? I've got a market. Now this thing over here, this summary profile shows me if I were to take all these profiles and put them on top of each other, this is what it would come up with. So now over the past 10 weeks or 8 weeks, I can see what the fair price is about 155 or 152 in Apple. So as long as Apple's above 152, it's carrying positive momentum. I don't know what happened with earnings today. I have no idea, but it's the same thing. And check this out. Remember I told you markets are getting these low volume things that keep going until when? Until it hit a high volume price. Boom. And that's where it's resistance. It's a cool tool that gives you the visuals, but it also gives you, with every chart, there's a spreadsheet that gives you all the information that's in there. Point of control, which is the high volume price. So on this one right here, the high volume price, right? That's what point of control is. So on 128, the week of 120, last week, the high volume price was 153.03. The time at that high volume price was 13 different visits that week. Cool. the value area high, the value area low, the difference in the range. So now I've got my average true range. And I've got the open, high, low, close for each one of those bell curves. I use this to create my strategies. I can export this into a spreadsheet and manipulate the data however I see. Saying, okay, I'll tell you what. Here's what I want to do. Where's Apple? And then I look at it and go, okay, what's average? The average time and price with Apple on a weekly basis is 14. So when I see that, and I'm going, okay, I know that it's 14, and I know that the average range is somewhere around 11. So what I want to do is I want to search for markets that have above average time at price. Ooh, there's one, 21, and below average range. Ooh, yeah. So that's a great combination. Time at price is too great. Below average range, got it. What does that look like? That's this one right here, 1210. And that's when the thing fell apart. That means the market was ready for a vertical move. I didn't know if it was going up or down, but the fact that it was below the fair price suggested that sellers were in control of the market. So start with a real basic knowledge of reading charts, and then take the dimensions that are available to us and take that to and then take it, wherever you want. If you're a long-term trader, you should be looking at monthly bell curves. If you're a short-term trader, you should be looking at least days and weeks. And I guess that's about all I got to say, folks. So again, at markettaker.com, JS/99 if you're interested. And if you want to get a hold of me, you can get me at jseguin@markettaker.com. And I can answer some questions there. So I see that I've got a couple questions. Yeah, trading is the best video game. You're right, Craig. How do you identify that a week or day is low or high volume? All I see are bell curve. Now, remember in the beginning here that time at price is the proxy for tracking volume. I could track volume at every single price, but the amount of data points that you need to put in a spreadsheet, I have to tell you that the structures that are developed, whether you're using actual volume or time at price, are very similar. As a matter of fact, I think using time at price is far better, first of all, because most strategies are developed off of time and price. And second, because it smooths out the bell curves, making it easier to see where fair is. It's just my style, and I found, and I've done the studies, that looking at time at price versus actual volume very little. Anyway, that's it, Donnie. I'm done, man. Yeah, I got nothing else to say either.
Well, that's when it's time to quit, right, John? Thanks, everybody, thanks for spending time with us today at this webinar. John Seguin's a fun guy. He's a great trading coach. He's a very good friend of mine, and he, we hope to have him back to do more of these events in our future educational package. You come to TradeStation a lot for our webinars and our educational events because as his goal, John's goal, and my goal, and our goal here at TradeStation is to make you a better trader, to give you the tools and the background and the assistance that you need. We don't endorse Market Taker Mentoring. We're not in any way affiliated with them. However, as you can see, their goals are they align very closely with TradeStation. So John was able to discuss and determine profit from fair value and different time frames. He offered us a lot of tips on how to improve the timing of our trade entries and our exits, and how to recognize the onset of momentum early in a trend. I hope that was valuable. If it was something that you believe that you can take advantage of down the road, contact the folks at Market Taker Mentoring and John Seguin and Dan Passarelli, and see if their coaching will help you become a better trader too. This is it for us here at TradeStation. We'll close out here. Thanks, John Seguin, and thanks everybody for spending time with us today.